The invisible distribution. What the smart money did while the tape looked calm by value and momentum portfolio. The surface of the market looks calm. Indexes near their highs. Tech leading. Most people feeling a lot better than they did back in March. But underneath that calm, something else was happening in May. Millennium cut its gross, long exposure by more than $15 billion. The Gates Foundation sold its entire $3.4 billion stake in Microsoft. Pershing Square dumped $1.6 billion of Google. Lisa Su sold $55.7 million of her own AMD stock. And somebody paid more than $10 million for long-dated puts on AMD. The rally was real, nobody should argue with that. But here's the case I want to lay out today. The most sophisticated money in the market used every tick of that rally to get out. And then, because this matters just as much, I'm going to spend a good chunk of this episode arguing against my own thesis. Because the difference between analysis and storytelling is whether you're willing to do that. The setup. Let me start with what this is. It's a piece of data synthesis. It pulls from 4 separate channels, and all 4 are public or close to it. Short volume from FINRA, unusual options flow from Oprah, insider sales from SEC Form 4 filings, and big institutional position changes from 13F filings. The window is May 1st through June 3rd, 2026. Now, 2 ground rules before we go further. First, for every seller, there's a buyer. The market clears. Every share that Millennium sold, someone else bought. So big names are selling is never by itself the signal, because big names are always selling something. The real questions are narrower. Is the selling unusual relative to its own history? Is it clustered in the same places across independent channels? And is the buyer on the other side weaker and later? That's the bar this has to clear. Second, I'm working from data that I'd want to verify against the primary filings before betting real money on it. Treat the specific numbers as a starting point, not gospel. The framework is what matters, and the framework holds regardless of whether any single figure is off by a bit. With that said, let's start with the shorts. The shorts. Short volume tells you how hard traders are betting against a name. And the standout here is NVIDIA. NVIDIA's short volume hit 38.6 million shares on May 21st. It eased off, then re-accelerated, back up to 35.5 million by June 2nd. Here's why that matters. The shorts didn't pile in when the stock was falling. They reloaded as the price recovered to new highs. That's a textbook signature of distribution. Selling pressure that gets heavier, not lighter, as the price climbs. Compare that to Tesla. Tesla's short volume fell from 19.4 million shares down to 8.6 million. That's covering. Traders closing bets, not adding. So Tesla is actually less alarming here, not more. The energy ETF XLE spiked to 13.4 million shares of short volume on June 1st, its highest since early May. And the financials ETF XLF showed persistent short pressure with QQQ elevated right through the rally. So the read is clean, the pressure is concentrated, and it's heaviest where the price is highest. Options. Now the options. This is where it gets specific. The single most striking data point of the month was Microsoft. On June 1st, 7 separate put sweeps went through. Strikes between $645 and $675, expiring in December and January of next year. All marked bearish, all executed at the ask. Here's the detail that matters. Microsoft was trading around $425 to $460 at the time. So those puts were deep in the money. Someone paid up to own in-the-money downside protection in size. You don't do that to hedge casually. That's positioning consistent with someone who expects the stock to fall, and soon enough for it to count. And it wasn't just Microsoft. More than $10 million of premium sat in long-dated AMD puts, out 6 months and beyond. There were aggressive near-term sweeps on NVIDIA. And the one I keep coming back to, somebody paid $1.9 million for a January 2028 put on QQQ, struck at $810 when the index was at $744. That position only pays off if the NASDAQ is below $810, a level it's already under, almost 2 years from now. Read it the other way. They wrote a check that says the NASDAQ goes nowhere or lower for 2 years. Insiders. Channel 3. The people who run these companies and what they did with their own stock. It clustered hard in technology. Lisa Su, the CEO of AMD, sold $55.7 million on May 13. Alex Karp, the CEO of Palantir, sold $54.1 million. The same day, two other Palantir insiders sold $43.5 million and $22.5 million. Frank Slootman, a director at Snowflake, sold more than $228 million across consecutive days. The single largest transaction in the whole dataset, $750 million, came from the Viessmann family at Carrier. Then the patient money heading for the exits. A full Gates Foundation exit of $3.4 billion in Microsoft, a near-full Pershing Square exit of $1.6 billion in Google. And one striking anomaly, the CEO of United Therapeutics, Martine Rothblatt, sold $5.4 million every single trading day for 14 straight days. Added up, and one number stands out. About 62% of all insider sale dollars in this window came from technology, AI, and software. Institutions. And the 13 Fs confirm it from the top down. Millennium cut more than $15 billion of gross long exposure in a single filing. The Gates Foundation Trust cut about $6 billion. Pershing Square, about $2.5 billion. Point72, around $5 billion. And the quants told the same story. Two Sigma sold the tech, ETF, XLK, directly. Underneath the indexes, the price action is the tell. From the March lows, XLK ran up about 51% in 12 weeks, and institutions sold into every tick. Energy went nowhere while the S&P rose about 16%, and financials rose just 4% against that same 16%. That last one matters most. Financials almost always lead a real bull market. Up 16 on the index, up 4 on the banks. That's a non-confirmation. So that's the footprint. 4 channels, 1 epicenter. Now here's where most newsletters stop, and here's where the actual work begins. Now let me argue with myself, because everything I just told you has a weaker reading, and an honest analyst has to sit with it. Start with the insider selling, which sounds the most damning and is actually the softest signal of the 4. Here's the uncomfortable fact. Insider buying predicts returns. Insider selling mostly doesn't. The academic work on this is decades deep. Lakonishok and Lee, later Cohen, Malloy, and Pomorsky. And it lands in the same place. When insiders buy with their own money, pay attention. When they sell, mostly shrug, because executives sell for 100 reasons that have nothing to do with their view of the stock. Taxes, divorce, a house, diversifying a net worth that's 90% tied up in one ticker. The base rate of insider sold, stock then fell, is barely better than a coin flip. It gets worse for the thesis. Most large insider sales aren't even decisions. They're pre-scheduled 10b5-1 plans, set in motion months ahead of time on autopilot with a mandatory cooling-off period. The executive doesn't pick the day or the price. So a sale that prints in May might reflect a decision made last autumn when the stock and the world looked completely different. If you want to know whether any of these sales carry information, the first thing to check is the Form 4 footnote. Is the 10b5-1 box ticked? If it is, the conviction story mostly evaporates. And the single biggest insider headline, the Gates Foundation selling $3.4 billion of Microsoft, is the weakest of all. The Gates Foundation has been a programmatic seller of Microsoft and Berkshire for the better part of 20 years. It sells to fund its grants and to diversify away from 2 enormous legacy stakes. Reading that as a market timing signal isn't analysis. It's a category error. The foundation was always going to sell in any month, in any tape. So is there anything in the insider data? Yes, a narrow something. The research that finds signal finds it in a specific subset, cluster selling, where several insiders at one firm sell in the same window, sales by CEOs and CFOs rather than junior staff, and discretionary sales rather than scheduled ones. So the Palantir cluster And the separate day CEO sales like Mary Barra's at GM sit in the part of the distribution that has historically carried more signal than a lone pre-planned sale. That's real. It's just a modest edge, not a klaxon. Now the 13Fs, same problem, different shape. A 13F is filed up to 45 days after the quarter ends, so it's a snapshot of where a fund stood weeks ago, and the position may already be gone. It shows long positions in U.S. listed securities only, no shorts, most derivatives, no cash, no foreign holdings. So you literally cannot read net exposure off it. And that's a particular problem for the headline name. Millennium is a multi-manager platform. So is Point72. These shops run enormous gross exposure with very tight net. Hundreds of pods hedging against each other. They turn over billions in longs as a matter of routine plumbing. So Millennium cut $15 billion of longs might be matched by an equal cut in shorts, leaving them net flat. Calling that deleveraging or a market call is reading tea leaves. The honest version is, we don't know their net and the filing can't tell us. And then the deepest trap of all, the historical analogies. I told you this pattern preceded 2000, 2018, and 2022. True, but think about how I selected those. I went looking for crashes that followed heavy selling, and I found them. What I conveniently skipped is all the times heavy insider and institutional selling was followed by the market grinding higher for another year. Markets almost always have big sellers. If you screen for, this looks like the top, you will find a match before every top, and before a lot of things that turned out not to be tops at all. Michael Mauboussin would call this the inside view talking, a vivid story about this specific situation, when what you actually need is the outside view. The base rate, and the base rate of scary-looking distribution leads to a real correction within 90 days, is a lot lower than the narrative makes it feel. So that's the case against me. It's strong. Hold on to it. Here's the other gap. Even if every figure in that report is correct, it only shows you flow. It doesn't show you the rest of the market, and you can't call the state of the market off one slice of it. So here's the dashboard the report is missing. And I'd rather tell you what to look at than pretend I have every current reading in front of me. First, breadth. Is this rally narrow or broad? If it's a handful of mega-cap names dragging the index while everything else stalls, that's fragile, and it supports the cautious read. If the equal weight index, the small caps, and the advanced decline line are all making new highs together, that's a healthy, broadening market, and it cuts hard against the distribution thesis. Pull up the equal weight S&P versus the cap-weighted one. That single comparison tells you more than any insider headline. Second, and most important, credit spreads. Credit is the smartest, earliest market there is. High yield and investment grade spreads lead equity trouble almost every time. So go look at the high yield spread. If it's still tight and calm, then the bond market, which is bigger and less emotional than the stock market, is not corroborating the equity warning. And distribution without credit confirmation usually fizzles into a dip, not a crash. If spreads are starting to widen, that's when I'd take the whole footprint far more seriously. Third, valuation. Distribution at cheap prices and distribution at rich prices are completely different stories. So where are we? What's the forward earnings, multiple on the index, and on the big tech names specifically? What's the equity risk premium? The earnings yield versus the 10-year treasury. If multiples are stretched and the risk premium is thin, the bear case has a foundation under it. If valuations are reasonable, then their selling just means they're rebalancing, and the downside is limited. Fourth, volatility and skew. Those Microsoft puts mean more if the rest of the options market is complacent. Low VX, cheap downside protection, a flat skew. If everyone is already hedged and the VX is elevated, then a few big put sweeps are just part of a crowd that's already nervous, and the contrarian read is actually bullish. Fifth, positioning and sentiment. Where's the crowd? Systematic and trend-following funds, equity fund flows, margin debt, the sentiment surveys. If everyone is already euphoric and all in, that's late cycle and supports caution. If there's a wall of cash on the sidelines and sentiment is sour, that cash is the fuel for the next leg up, and the sellers are early. And sixth, the thing the entire AI trade actually rests on, monetization. Is the AI capex turning into revenue and free cash flow yet or not? The bear case and the bull case for NVIDIA, Microsoft, and the rest both live or die on that one question. Insider flows are a sideshow next to it. One last structural point, and it ties back to something I harp on. The index itself is more concentrated in a few names than at almost any time in its history. That's a genuine fragility. Not because those companies are bad, but because owning the index now means owning a handful of correlated bets dressed up as diversification. Position count is not diversification. You have to count independent return drivers, not tickers. And right now the market is leaning hard on very few of them. So what do I actually believe? So where does that leave me? Somewhere with a view, but holding it loosely. The signals split into three honest buckets. The options data, the in-the-money Microsoft puts, the long-dated bets, is the smallest group, and it's the one truly positioned for downside. The 13F data is the biggest, and most of it is just gross long reduction in pod shop churn, not a macro call. And the insider data sits in the middle, saying, at most, that the people who know these businesses think they're fairly valued here. Not collapse, just more downside than upside from these levels. There are three names where the channels stack up cleanly, and those are the only ones I'd actually act on watching. Microsoft is the strongest. An insider sale, the Gates exit, re-accelerating shorts, and 7 in the money put sweeps. 4 signals on one name. Walmart, where short volume jumped 86% while the Walton family trust sold day after day. And GM, where Mary Barra sold $37.2 million across 3 separate days. Discretionary, separate day, CEO selling, the subset that actually carries signal, with short volume up 40%. Now let me say plainly how I could be wrong. If earnings keep growing and the AI capex starts converting into real cash flow, the expensive names grow into their multiples and the sellers look foolish. If breadth broadens and the financials catch up, and remember, financials catching up would directly destroy my non-confirmation signal, then this was just a pause. If the Fed eases into a soft landing, liquidity carries multiples higher. And here's the humbling part. Selling Microsoft and Google over the last decade was, for almost everyone who did it, a mistake. Great compounders have made fools of better sellers than these. Bessembender's work is the reminder. A tiny handful of stocks create all the market's wealth over time, and the cost of selling one of them early is brutal and permanent. Cliff Asness has a whole paper on how hard it is to time even an expensive market. The short version is that valuation tells you about long-run returns and almost nothing about the next 12 months. So I'm not making a market timing call, I'm calibrating. The footprint tells me that, at these prices, the best informed money was a taker of liquidity, not a buyer of it. And that's worth respecting. But respecting it means adjusting your sense of the odds, not pretending you know the date. Here's the line in the sand. If financials break below their March range and the NASDAQ fails to make a new high, and especially if credit spreads start to widen, then the distribution phase is probably finishing and the markdown has begun. But if the banks catch up, if credit stays calm, and if the NASDAQ makes a clean new high, then this thesis is wrong, and the disciplined thing is to admit it and move on. Let me bring it home to how a long-term investor should actually use this. None of it is a trading signal. I'm not telling you to sell, and I'm definitely not telling you to short anything off 1 month of filings against 100 years of evidence that says the market drifts up and a few great businesses do almost all the work. What a footprint like this is good for is calibration. It nudges your sense of risk and reward. It does not hand you a date. If you own a genuinely great business, the lesson here is not to flee. It's to know exactly what you own and why, to size it so a 15% drawdown doesn't break your psychology, and to never mistake a 51% 12-week rally for permanent value. Distribution never tells you when. It tells you that the easy money in this particular move has probably already been made by someone else. So watch the financials, watch credit, watch whether the NASDAQ can make a new high, and let the price action, not the prediction, and certainly not the story, tell you when it's real. Disclaimer. One note before we close, and I mean it. Everything here is data synthesis for research, not investment advice, and not a recommendation to buy or sell anything. Several of these figures come from automated data tools and public filings I haven't independently audited. So verify the numbers against the primary sources before you rely on them. And I am not your financial advisor. Do your own work.